Presentation and disclosure of inventory information are essential components of financial reporting because they provide analysts and investors with detailed insight into a company's inventory valuation methods, operational efficiency, and earnings quality. The program emphasizes that inventory disclosures improve transparency and help users understand how accounting choices affect reported financial results. Inventory is typically presented as a current asset on the balance sheet because it is expected to be sold within the normal operating cycle. Companies must disclose important information regarding inventory composition, valuation methods, carrying amounts, write-downs, and reversals when applicable. These disclosures allow analysts to assess liquidity, profitability, and operational risk more accurately while improving comparability across firms and reporting periods. Inventory disclosures generally include the accounting methods used to value inventory, such as FIFO, weighted average cost, or LIFO under US GAAP. These methods significantly influence cost of goods sold, ending inventory values, and profitability during periods of changing prices. Analysts rely on disclosure information to adjust financial statements and compare firms using different accounting approaches. The program notes that LIFO is not permitted under IFRS, while US GAAP allows it. Therefore, multinational comparisons require careful interpretation of inventory disclosures and potential adjustments for accounting differences. Transparent reporting of inventory methods helps investors evaluate earnings quality, tax implications, and the economic realism of reported asset values under varying inflationary environments. Companies also disclose the composition of inventory balances, including categories such as raw materials, work in process, and finished goods. These disclosures provide insight into operational activity and inventory management effectiveness. Changes in inventory composition may indicate shifts in production, demand conditions, or supply chain management. The program highlights that rising finished goods inventory relative to sales may signal declining demand and decreasing inventory turnover. Analysts evaluate these trends carefully because excessive inventory growth can increase storage costs, raise obsolescence risk, and reduce liquidity. Conversely, inventory levels that are too low may indicate inadequate stock availability, potentially causing lost sales and operational disruptions within the business. Inventory presentation and disclosure also include information regarding write-downs, impairments, and valuation adjustments. Accounting standards require companies to reduce inventory carrying values when inventory becomes obsolete, damaged, or worth less than its recorded cost. These write-downs are recognized as expenses on the income statement and reduce inventory values on the balance sheet. Under IFRS, companies may reverse previous inventory write-downs if values recover, whereas US GAAP generally prohibits reversals. Analysts review impairment disclosures carefully because significant write-downs may indicate operational inefficiencies, poor forecasting, technological obsolescence, or weakening market demand. Frequent or unusually large inventory adjustments may also raise concerns regarding management effectiveness and the reliability of financial reporting practices. Inventory-related disclosures are important for evaluating financial ratios and overall company performance. Measures such as inventory turnover, current ratio, gross margin, and asset turnover are all influenced by inventory valuation and presentation choices. The program explains that using FIFO rather than LIFO during inflation generally produces higher ending inventory balances and higher current ratios. Analysts therefore examine disclosures to understand how accounting policies affect liquidity measures and profitability trends. Common-size balance sheets and horizontal analysis further assist analysts in identifying unusual inventory growth patterns, declining turnover efficiency, or changes in working capital management that could influence future cash flow generation and business sustainability. Effective inventory presentation and disclosure enhance the transparency and usefulness of financial statements for investors, creditors, and other market participants. Detailed disclosures help analysts evaluate inventory quality, operational efficiency, earnings sustainability, and the potential impact of inflation or changing market conditions. Because inventory often represents a significant portion of current assets, accurate reporting is essential for assessing liquidity and financial stability. Analysts combine inventory disclosures with broader financial analysis to identify risks, forecast future profitability, and evaluate management effectiveness. A strong understanding of inventory presentation and disclosure enables analysts to interpret accounting information more accurately, improve cross-company comparisons, and make more informed investment, lending, and valuation decisions within global financial markets.